Good day, ladies and gentlemen. Thank you for attending Northstar's session of Meet the Managers. I'm Adrian Clayton. I'm the co-manager of the Northstar SCI Managed Fund. I've been managing Regulation 28 unit trusts for 23 years, starting in 1999. I joined the market in 1995, and I was lucky enough to be introduced to the market and the dynamics thereof at an early age. My father used to trade gold in the 1980s. Our session today really revolves around asset allocation and our views of the asset markets, and hopefully we'll give you some insights into our thinking. Just in terms of the long-term track record of the funds we've managed, we've been runner-up or won awards across this fund over many years, and it continues to be a top-performing managed fund in its sector, and we'll talk to it at the back of the presentation. Asset managers really only have three reasons for existence. The first is to understand if a security or company is going to generate cash flows over time. The second is to understand the growth of those cash flows. And lastly, to try and understand what discount rate should be used to discount future cash flows back in today's present value terms. So, as I mentioned, we've got to understand a company's cash flow, try and work out what growth that cash flow is going to deliver, and then bring that cash flow back into today's money terms to understand what an asset is really worth. In theory, that's very easy. In practice, there are a lot of influencing factors that influence us. At the end of the day, we are human. So what does affect us? What do we think about when we're valuing companies? So I've put down various thematical themes or themes that are in the market currently that are really driving our focus when we're valuing stocks right now. Inflation, interest rates, debt, demographics, inequality and regulations that apply in the markets, and of course, valuations. So let's start with inflation. We understand what inflation is. It's the reduction of purchasing power over time. And simply put, we've shown coffee and how the price of coffee rises over a 50-year period. But inflation, by definition, is really too much money chasing too few goods. And an inflection point happened in inflation between 2020 and 2021 due to COVID. And we show here the graphs of a disinflationary world prior to COVID, with inflation dropping around the world. Even Japan had deflation. And then suddenly this inflection point happens in late 2020, early 2021, and we watch all those graphs escalating. Why is this important, and what has caused inflation? Well, as we mentioned, that by definition, it's too much money chasing too few goods. But the sources of this inflation are intriguing. On the one side, you've got a demand-driven problem. And we can look just, for example, at US households. Prior to COVID, in 2019, households were polled, and 44% of households between the ages of 25 and 60 could not afford an unexpected cost of $400 in any 1 year. Take the COVID crisis, the average person in a household got $3,200 that year given to them. Couples got $6,400. And if you had any dependents, you got an extra $2,500 given to you. That same poll run a year later, only 33% of households still concerned themselves with paying a $400 bill they didn't know about. So what we got was excess consumer-driven demand. The second point is supply. So we spoke about inflation having two components, demand and supply. With respect to supply, if you want to understand what actually happened with respect to supply chains and how they were broken, on an average year in December, Americans sit with 1 million cars of stock. In 2021, they only had 77,000 cars or vehicles of stock left. That's a dramatic difference to an average year, hence the price of cars rising. There's a third reason why we had inflation. that is excess money supply. $18 trillion of money supply exists in the US system. The Fed pumped in $120 billion a month of excess money into the system to stoke higher prices and demand. And then lastly, the fourth reason is that the Fed, together with the fiscus in the US, worked collaboratively to stimulate the system, and we saw that right around the world. Why is this important, though? What does inflation mean? Well, what we show here is in red US inflation, obviously rising precipitously of late, and against that, the earnings yield of the S&P. What is the earnings yield? Well, like any investment, think of a money market account, it has a yield on it. So too does the equity market. Investors demand a high yield from equities, as they do from anything else. When inflation moves higher, investors demand that yield to rise. And what we can see in 2020 is inflation has spiked, but the yield has not compensated investors. So three possible outcomes. Either earnings have to rise on S&P companies, and they're already on a high base in terms of profitability, or we have to see inflation drop, or lastly, we have to see the market correct. There is a possible fourth outcome. All of those happen collaboratively. The point we're making is inflation is rising. The market has not compensated investors appropriately. The next point or theme out there is interest rates. And I just made the comment, my slide is that the cycle has clearly turned. And I juxtaposed two different periods, but they're right on top of each other, 2021 to 2022. In 2021, a quite euphoric Buffett says, low interest rates are to equities or assets what gravity is to matter. And he makes the point that if you reduce gravity by 80%, matter, in his case, if he was an Olympic athlete, he could be a high jumper in the Olympic Games because there'd be no gravity. Similarly, if you're going to reduce interest rates the way the market has, the way the Fed has, it increases the value of assets. And that's just in 2021. And that was the thinking at the time in the markets. Let's move forward to 2022. Suddenly, Jerome Powell is warning about interest rates rising consistently, even though he was someone that was saying that the Fed could probably work its way through the system without dramatic changes in interest rate policy. So we've seen quite a lot of drama unfold over 1 year. Why are interest rates important? Well, what we've done here is we've taken interest rate cycles going back to the 1950s. 10 rising cycles and 10 cycles where interest rates have dropped. What is intuitively we assume that when interest rates are being cut, the market should rally. And when interest rates are being increased, the market should start to fall. But in practice, what we've seen is that there's a lag effect of at least 12 months up to 20 months, where the market does very little and in fact operates exactly the opposite of what one's intuition would demand. What we see is that in hiking cycles, the market actually moves up initially before it corrects. And in falling cycles, the market actually falls and later starts to move up. Our theory behind this is that there's momentum in the system. So currently, the market continues to be very strong despite the fact that we know interest rates are going up. But in time, those interest rates will bite and the market will correct. And our point of the slide is interest rates do count and there's a lot of complacency in the system. The next theme is debt. And there's an excessive amount of debt in the system. We've seen the largest increase in debt in 50 years in the markets, to the point where there's $80 trillion of GDP in the global system, and debt is 3 times that level. Why is debt important? Well, it's important for two specific reasons. Firstly, marginal cost versus marginal gain. The amount of debt it's taking now for governments to create $1 of GDP is 3 times higher than it was just 10 years ago. $1 of debt created $1 of GDP 10 years ago. Now we're needing $3 and $4 of debt to create $1 of GDP. The second reason why debt is important is that what we see is that historically financial crises have originated after big periods of debt increases. And we've seen 3 periods like that in the past. In the 1960s, 1970s and 1980s, sub-Saharan African countries got into big debt, and so did South American countries. That ended in the Mexican crisis in 1991, where the peso devalued and Mexican banks came under extreme pressure between 1991 and 1994. The second big spurge in debt happened in the later 1990s. There, in particular, we saw Asian countries and companies take on a lot of debt, as well as certain European countries, most specifically Russia. 1998, we saw the Asian crisis unfold. It lasted to 2001. It was a big drama in world markets, but again, a function of excessive debt taking before that event unfolded. Then, of course, we had the GFC, 2008. That originated in Europe, with banks taking excessive lending and increasing the size of their balance sheet, as well as investment banks in the US. It led to a housing market crash, as well as, we know, a stock market correction. 3 major debt events. The point is, those debt events pale into insignificance relative to what we're seeing currently in markets. Then, of course, there's the Fed's balance sheet. The Fed has increased its balance sheet to $9 trillion. Now, that's an asset on their balance sheet. They've been buying bonds and other assets, mortgage-backed securities in the market. But we're asking ourselves the question, how does the Fed reverse the size of its balance sheet without affecting the market? It's got to find buyers for $9 trillion of investments. It owns 25% of the treasury market in the US currently. Our fourth theme is demographics. The world's population is aging, and this has dramatic long-term consequences for investors. Who's going to fund the big debts that have been created as the populations age? And we can see this in this particular slide. 60-year-olds are becoming a larger and larger percentage of population groups. By 2050, approximately 22% of the world's population will be over the age of 60. This is critical because 60-year-olds aren't workers, and GDP grows because you have to have a working class. So countries grow when workers go to work. And what this slide shows, very simply, is the number of people that are moving out of the working cohort and getting older and older, and countries are losing their working populations. We see that right across the developed world. It's important for the following critical reasons. Firstly, GDP growth is a function of 2 things: the number of people you have working and how productive they are. Now, to get more people into the population, you have to have babies, or you have to have immigration. And another theme that's very pervasive at the moment is nationalism and the removal of immigration across borders. So unless we have more people moving into certain countries, particularly Europe and the US, we're not going to have the right number of people entering the workplace and being productive. So that's an absolute pull in terms of GDP growth. There's, of course, always something positive when it comes to markets. And here we look at the demographics in terms of population growth overall around the world. So the world is expected to have 9 billion people by the year 2050. That's the graph on the left-hand side. What's important to notice, however, is the dark blue area. It's happening in the developing world and not the developed world. Only one country, major economy, is expected to have growth in their population, and that's the US over this period. The rest of the developed world is in fact shrinking. Now, here's a key point with respect to that blue area. It's coming from 2 specific zones on the globe: Africa and Pakistan. Here's another key point. It's very difficult to predict fertility. It's very difficult to be sure that we will have 9 billion people on the planet. And I'll give you a simple example of how we know this. Iran, in the 80s, used to have a population growth rate of 5.6 children per family. 20 years later, that had dropped to under 2. You need at least 2 kids per family to keep the world's population at current levels. So when we prognosticate about rising population groups, we're assuming that the population growth rate will exceed 2 kids per family. But here's another key point. Is Africa going to drive GDP growth for the world? Because that's what we need. If population groups are diminishing in other countries and getting older, we need someone to pick up the slack. And unfortunately, what we know is that the top 10 nations 100 years ago were exactly the same top 10 nations bar Korea 100 years later. And Africa never made it into that top 10. So to get GDP growth, we need Africa to do a lot right for the world. On the right-hand side, we've got the emergence of the emerging market middle class. This is a key theme for asset managers. We can see that more and more population groups are rising in terms of being in the middle class. They consume more products, they're wealthier. It's good for demand, it's good for GDP growth, it's good for stocks. Inequality and driving regulations. It's not a point that's often spoken about by asset managers, but it's becoming a key theme in markets. On the left-hand side, we've got Senator Elizabeth Ann Warren, and she hails from Massachusetts. She represents, in my slide, the West. In the middle, we've got Xi Jinping, which we all know is the very dominant leader of the Chinese Republic. And he's introduced common prosperity. And in my slide, he represents the East. And in the far right, we've got South Africa. On the front page of Time magazine, the world's most unequal country, represented by a township on the right and a suburb, probably Sandton, on the left. Why is this important? Well, what we're noticing globally is a concerted effort by regulators to intervene to deal with inequality. And it's happening through regulation. And some examples of what Senator Warren wants to do, she wants to impose a 2 to 3% capital gains tax on all rich people in the US, or a wealth tax. What we also have seen her try to do is break up the banks in the US. And her latest target is Wells Fargo. That has an undermining influence on capital markets. In terms of common prosperity in China, we only have to look at Tencent's share price in the last year, 30% down, to understand the implications of common prosperity. And then in South Africa, we have 44 labor laws, 3 dominant labor laws, but 44 separate laws. And what's interesting is we're now proposing amendments to the Promotion of Equality and the Prevention of Unfair Discrimination Act. And we have no issue with those, except it will affect the markets, because one of the key issues is the bill intends to broaden the scope and definition of equality to include equal rights and access to resources, opportunities, benefits, and advantages. We know that that has what these kind of regulations do to capital markets. But we also understand why this is happening. The 1% richest group of people in the world own 46% of the world's wealth. And 55% of the world's population only own 1.5% of the world's wealth. That disequilibrium is causing stress in the system and introducing regulations into the market. And also, another slide which we think is particularly interesting is the top 10 billionaires globally, collective wealth exceed the GDP of many of the biggest countries in the world. Our last slide with respect to this particular point demonstrates the top 10% of earners in each country and what take they have of the total income of each country, each of those countries which we're showing. And what you can see is the graphs are rising. So the top 10% are earning more and more of the total income of those specific countries at the expense of the other 90%. And what's scary is that South Africa is at the top of that, We're the red graph, growing precipitously over time. More than 60% of South Africa's income goes to 10% of our population. My last pointer with respect to themes is valuations. And we've put this slide together, perfection ahead, because in our opinion, the US markets are to some extent valued with perfection. But there's a warning. The path will not be easy. We start with a slide of operating margins, profit margins in the US, all-time highs. Some would argue that that's normal when an economy develops. You move from producing widgets to producing IT products, and your margins are going to be higher. And we buy that. We understand that. But what the graph doesn't show is those margins are at the expense of labor. And labor now is demanding a bigger slice of the pie. Margins are high in the US, difficult to sustain that level of profitability. Our next graph is a little trickier, but what we show here is this S&P real earnings yield in blue against the S&P 500 index in red. And what we're trying to show in green is that bull markets always start when the earnings yield is high. And you see that in the green columns that we show. So if you want to take your chances and bet on a bull market, wait for the earnings yield to be at a high point. Contrary to that, bear markets and dead markets start when the earnings yield is low. And what we can see in 2022 is that the earnings yield in red on the far right of the graph is the lowest it's ever been. When we look at the cyclically adjusted multiple on the S&P 500 or the CAPE index, we can see that the markets are at all-time highs here, while interest rates are at all-time lows. Interest rates are not going down, they're going up. And that multiple requires excessive levels of profitability to sustain it. We see extreme valuations across many stocks in the US market. What we've then done is we've looked at the current PE or forward P on the S&P, and we've looked back historically and said, well, what kind of returns can an investor get off this kind of PE? And what we show is that an investor would get 5% annualized returns nominal. But if we think that inflation is going to be 2 to 3%, that means only a 2% real return annualized. And a rational investor would want 7 or 8% real from the markets. So we see low prospective returns coming out of the US market. But that overvaluation, fortunately, is not homogeneous. And what we show here is there are various markets, the Nikkei, the Chinese market, European markets, and emerging markets that are not nearly as overvalued as the US. A similar graph, just showing the emerging market average PE over time and how many markets trade below that. And I just take Brazil as an example. It's been a terrible underperformer. Its currency is devalued, the stock market has done terribly, but suddenly in the last 2 months there's been a boom in Brazil stocks. So there's action out there in cheap markets. What we show here is that emerging markets in red are the cheapest they've been against developed markets since 2004. So that's the good news about emerging markets. But here's the negative news. Emerging markets need to grow their GDP. And unless they do that in a more consistent way, there's no natural tailwinds for those markets to perform. And we've used South Africa as an example of terrible GDP growth over time, stuttering along. We've watched Sona and we watched the president try to address this. But unless we see more consistent GDP growth, South African market will be perceived more as a value play at times than a consistent perpetual performer. When we look at the South African market, the FINDI at the moment, and we look back to see what kind of returns you could get off the current PE, you're getting double-digit returns at least because the market remains relatively reasonably priced. Now, as we sum all that up in terms of asset class returns against a benchmark for each one of those asset classes, our benchmarks are in red. What a rational investor would expect from each one of those asset classes against our expected returns with all our modeling, which includes many of these themes that we're grappling with. And what we can see in a nutshell is that South African fixed income assets on the left-hand side of the screen generally meet their expected return hurdles. South African equities in the middle of the screen also meet their expected return hurdles. However, on the right-hand side are developed market assets, and they do not meet the expected return hurdles. That brings me into how our fund is currently positioned. As you would imagine, considering our view that South African equities remain cheap, last year we moved exposure out of offshore assets into South Africa. And now our local equity component of the fund is larger than our strategic benchmark. With respect to South African bonds, we did the same, selling global equities last year and put it into South African bonds yielding 10%. It was a no-brainer for us. The currency was undervalued, South African rand was undervalued, and bonds were dirt cheap against an expensive global market. And then on the right-hand side, we've gone underweight global equity, and we at-weight gold as an insurance policy against tough times. I'm going to conclude with this slide. And it shows on the x-axis, the horizontal axis, the amount of risk that managers take in funds in the balanced sector. On the y-axis, or the vertical axis, it shows the returns we generate. The slide is a month old, but it's 36 months of data. And it's interesting in the following way. It represents a period of high risk-taking in markets, which is unsuited to our style. We're a relatively low-risk manager. However, we still gave the same return as the peer group over 3 years, but we did it at a fraction of the risk versus our peers. What is also important to note is there's some managers to the far right. They took big risk, but they got the returns, and good for them in a market that paid you to take that kind of risk. But we don't think the market suits that style going forward. And what we can say is this graph has actually changed over the last month. And the little dot, blue dot to the left of the red dot is our major competitor that we've been competing with for years. And we've now overtaken that particular competitor, giving higher returns with lower risk. And to us, those two managers, ourselves and that particular competitor, are well suited to the environment that we're going to see in the next few years. Trench warfare, tough markets, unsuited to managers taking excessive amounts of risk. So what we say, and as we conclude this presentation, is that our particular fund gives a lot of bang for the amount of buck or risk that we take. And we think that is an exceptionally good place for investors to hide in the years ahead. Thank you very much.